as we get ready for the Q&A portion, you know, I'm just going to ask my partners the question that a lot of you are asking and thinking about, I'm sure, if you own your own business. And then we'll take some general questions. We've been told we can go a little longer for people that are interested. And again, we're going to be in New Orleans. So the question is now the right time to sell your business? And Jan, you get the first shot, and then Ron, you'll answer that question, and then I'll give you my 2 cents. Jan?
Yeah. So if you ask the question, is now the right time to sell my business? It means that you're actually thinking about selling your business. So if you are, then the answer is yes, now is the time to sell your business. And the reason is twofold. The first is the lack of predictability. Monty Python once said nobody saw the Spanish Inquisition coming. Well, nobody saw the pandemic coming. We don't know what's going to happen in the next couple of years. There's no certainty that if you don't sell now, that your company will be worth more down the road. So it's a guessing game all around. So the object is to get fair value. And you're in a very favorable position right now for 2 reasons. As we said, there's a lot of heightened interest in doing acquisitions in the logistics space. And the other is you've probably just pocketed a windfall amount of money. So it's you're better positioned to take a little more risk in selling the company than you would have been before. Everybody wants to sell at the top, right? Sell, buy low, sell high. If you want to sell at the top, you need to get a time machine and go back 2 years. But for lack of that, you should prepare now. Because the risk has gone up, because the predictability has gone down, the risk has gone up. The buyers are taking less risk, and one of the ways they're taking less risk is by being ever more diligent in the due diligence process. They're digging deeper and deeper, spending more money in the process. And that means that the sale process is longer than it used to be. Something that used to take 5 months is taking 7 months now. If you went to market now, you'd be fortunate to close your deal by the end of the year. If you go to market, if you wait a few more months, it won't be until 2024. So better to do it now than to wait, because there's no certainty in waiting, and it takes a long time to get the deal done anyway. The other reason to do it is that you don't really know what your company is worth and what you're going to get until you go to market. And once you go through the process, you'll find out one of 2 things. Either the company is worth what you hoped it would be worth or more, and you make a deal, or it's not, and you get a roadmap to what you need to do with your company to position it to get that amount of money later in the process. So there's no downside here. Even if you go through the process, there is in essence a payoff for going through the process, either by completing the deal or getting the roadmap. Ron, what do you think?
I agree, Jan, and especially on the roadmap portion of it. I'll be quick on my answer so that we can get to some Q&A here, but just 2 things that I want to discuss. First off, is a really good way to get a roadmap, and we like our sellers to do this. And anytime you deal with, especially with a financial sponsor, they're going to do it if they're interested in buying you, and they're going to do what's called Q of E. You'll hear the term Q of E. It's quality of earnings. It's not an audit. It really looks at your business, does look at all the financial aspects of your business, but it looks at the story of your business and everything else, and it comes up with a really good roadmap of valuation and the red flags of your business. So we think that that's an excellent thing that you should look at. But it leads me to my final point. And my final point is, don't wake up one morning because of some type of an emotional decision, whether it's something that happened in the business and you just don't want to do it anymore, or a family issue or something that's happened in your family, and you just decide, I woke up and I want to sell the business. Don't do that. As I mentioned early on, we have this Logisyn education series, and if you send us a question on it and you want the information, we can send it to you. But we wrote a white paper on this a couple of years ago. It's called the 5 Ps, and proper planning prevents poor performance. I think that's real important for you to understand. Plan for an exit. Most people don't have an exit strategy, and you need to have an exit strategy and how you're going to do that and how you're going to work around that. I think that's critical, and make sure that you know when you get to that point of looking at a potential buyer of your business, or you're looking at buying somebody's business, that cultural compatibility is the right fit for you on both ways. 50% 50% of all mergers and acquisitions don't live up to the expectation of the buyer, and that's because of cultural compatibility. So Chris, I'm going to turn it over to you.
Yeah, so I agree with that, obviously, but I kind of take an entrepreneur approach to it. I was 42 years old. We'd built 10 years. CargoWise was our product in the United States, and again, I'm not taking credit for everything that happened, after that, because there's been a lot of acquisitions and a lot of things that have happened. But our customers loved us. I was having fun. We had a great future. We're finally making money. At least a little bit of money. And, we had a phenomenal team. Many of them are good friends of mine. They're still at CargoWise. So why did we sell? And, my Danish partner wanted to go back to Denmark. We were looking at that. And, our customers loved our products, but they wanted us to do more. Our US customers wanted to go overseas. There were a lot of things that I could see as growth opportunities. So at 42, I was like, yeah, I could see a huge opportunity here, but the risk of it was massive. And probably like a lot of the entrepreneurs on this call, right? You know what you could do to build, an Expeditors, but it's going to take a lot, right? You might have to, do a lot of things with that. And I just happened to meet Richard White, at that time, and we put our companies together. We'd raised a little bit of money, and that's an example of what a merger can do for a company, not just for the owners, but also for the employees and for the customers. It does. There are the horror stories like the 50% because they did put the wrong companies together. But if you put the right companies together, it's not necessarily a horror story for your customers and your employees. It can be the best thing that ever happened to them. And, they can grow, they can make more money, they can have career opportunities, your customers can do more things with you, they can be even more loyal, give you more business. So, everybody seems to focus on the negatives of M&A. Sometimes it's a dirty word, and people that do M&A, I feel very proud of what we do. I got a message that I shared with our team yesterday, true story, from a client of ours that we helped that just called to just thank us about how's it gone so far. I don't consider a deal a good deal is if both the buyer and seller aren't happy with the deal, and we keep in touch with them, right? So hear the horror stories, be aware of the horror stories, but just realize M&A is not always bad. So with that, Megan, we're gonna, turn it back to you, and you ask any questions that you want to ask. And again, I know we went on, I think we're going a little bit over time, but I think we can also, continue the questions offline too. So back to you, Megan.